Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. Today, a new guest, Rick Rule. He is the chairman and founder of Sprott USA. Mr. Rule knows all about bullion and resource investing, gold, silver, palladium, you name it, he knows about it. Mr. Rule, thank you so much for joining us today on USAWatchdog.com.
Pleasure to be with you. Thank you.
Well, first off, let's talk about last week's smackdown on gold and silver. It's funny, I mean, commodities like corn and beans were up, but yet gold and silver, got hammered. Can you give us your insights on what's going on?
Well, I think it's interesting, the phrase hammered. The gold price on Friday off $70 from a $1,500 base. Having been 30 years in financial markets, it doesn't really feel like a hammering to me. I guess that's a difference of opinion. Interestingly, earlier in the week, I had some discussions with some of my institutional clients, and they said, Rick, gold has been soft. When is it going to move? And the response that I gave them, I think, is instructive for your listeners. I said, it's going to move in July of 2000. Then it was $252, and now it's $1,500. We've had a six-fold move in 12 years, and people ask me when gold's going to move. They seem in periods of weakness to be concerned about the fact that gold is off $70, when in fact what it is up $1,300. I have a very difficult time understanding people's perception about what it is that they own gold for. Certainly, if you are a short-term technical trader and don't own gold for the reasons I own gold, which is to protect your purchasing power over time, a $70 down move is a problem for you. If, however, you are owning gold to protect your purchasing power over time, the $70 down move is one of two things, either inconsequential, or if you're attempting to augment your holdings of gold to protect your purchasing power over the next decade, in fact, an opportunity. In other sets of circumstances, we would call a down day like this a sale, if we were out to buy a suit of clothes or a can of tuna fish. Because it involves a financial asset, for some reason we would prefer to overpay rather than underpay. So for me, and I don't mean to be cavalier, it's a non-event.
Well, what about the folks that are saying, Paul Craig Roberts was on this week and says, they're printing money around the globe like crazy. There's all kinds of instability, and, they're shorting into a gold market. He says, this is the government. This is manipulation, at least. Other people say, well, a lot of people are exiting out of GLD and SLV. Gregory Mannarino, one of the guests on this show, says, they're exiting out of GLD and SLV, but, that's just a paper market. They're wanting to hold the physical metal. So you're seeing these price movements as people are getting into physical. What say you?
I work at a place where there is a lot of support for the idea that there is a broad-ranging conspiracy against gold and against other precious metals. I am not personally of that point of view, but it's worth noting that I work at a place called Sprott. He doesn't work at a place called Rule. He's been right over time. From my own viewpoint, I can explain the softness in gold without resorting to conspiracy. And it goes like this. People's expectation of the future is set by their experience in the immediate past, first of all. People don't take gold in a 10-year context or a 1,000-year context. They take gold in a 30-day context. And the set of circumstances that makes gold go up are unfortunately very, very, very unpleasant sets of circumstances. People search for information that reinforces their existing paradigm. And most investors, I think, would like to believe that Mr. Obama and Mr. Boehner and the people at the Fed can stick handle through the set of circumstances that we're involved in today. There is, I think, a hope in the investment community that given the fact that we managed our way through the 2008 decline, that we can manage our way through other difficult circumstances, and that, in fact, central bank liquidity is a substitute for solvency. I don't personally believe any of that. And so from my own point of view, I believe that the current anti-gold bias in the market is wrong.
Well, David Stockman last week, the former White House budget director in the early Reagan years, says that this is, when they stopped this $85 billion a month money printing, $40 billion for the mistakes and fraud of bankers and $45 billion to buy treasuries, and might I add my own 2 cents? That's what we know about. He says it's going to be over. It's game, set, match. I mean, the markets will be, in calamity in 6 weeks. I say 6 weeks, 6 minutes, 6 hours, 6 days, not 6 weeks. So all that said, do you think we're headed for a collapse? And are your clients bracing for it and buying gold and silver while it's on sale, as you say?
I can't speak for all of my clients, but I need to say that the clients that I've had direct conversation with, either in person or on the telephone, now understand that many of these clients have been with me for 2 decades. I would say that our client base is unusually attuned to buying gold and buying precious metals equities on dips. Now, in a sense, you're asking the question from a self-selected database because they wouldn't be my clients if they weren't predisposed to that type of action. But I'm very impressed with the way the Sprott client base generally has reacted to a softness in its favorite sector.
You're not worried? Your major clients that you've talked to, not worried?
Oh, sure, some of them are worried. Of course, when you believe that you are taking an action that is in response to market conditions that lead to an inevitable result, many of us confuse the words inevitable with imminent. And the fact that we're right doesn't mean the fact that we're right on a timely basis. And it's easy to have your own faith in your conviction challenged by things like a 70% decline in the gold price. I just ask the customers to consider what are their alternatives. Perhaps you'd like to buy a 30-year U.S. Treasury, something that Jim Grant famously described as return-free risk. Perhaps that's the place you'd like to go. Perhaps rather than studying 2,000 years of history with regards to gold versus fiat currency, you would prefer to trust Geithner or President Obama. Perhaps because Goldman Sachs said that the gold trade was over. Perhaps you believe that your guru is Goldman Sachs. They were, of course, so right about the mortgage business in 2007, 2008. They're very credible, aren't they? I mean, perhaps that's what you would like to do. Yes, of course, the gold price is off. That's happened before. If my memory serves me well, we've had 7 or 8 corrections in this gold bull market, which began in 2000. Corrections are normal and they are natural. Some of your viewers will remember the gold bull market that we so enjoyed in the 1970s, when the gold price ran from $35 an ounce to $850 an ounce. Many people won't remember in 1975, in the middle of that epic gold bull market, the gold price fell from $200 an ounce to $100 an ounce. You had a 50% cyclical decline in a secular bull market. People who got shaken out of that market in that decline missed a move from $100 an ounce to $850 an ounce in 6 years.
Do you think we're going to a 50% decline?
I have no idea. I have absolutely idea. I mean, if you ask me what I think, the answer is no. What I can tell you is that in the near term, almost anything can happen in a market. I've been involved in these markets for 35 years, and the only thing that's been consistent on a quarter-by-quarter basis is I've been surprised by something. And so the idea that we could have a further cyclical decline in a secular bull market is something I'm personally very comfortable with, because I think about the alternatives. And what are my alternatives? The U.S. 30-year Treasury? I don't think so. The renminbi? I don't think so. The Japanese yen? I don't think so. Perhaps I'd like to put my money in a Cypriot bank. I don't think so.
You know, there's a phenomenon that happens. Paul Craig Roberts is bringing it up. As the price goes down, people like your clients start saying, hey, wow, it's on sale, and they start buying it. Commissions rise, supply declines, and at the time you think, oh, this is a good deal, there's no supply. Do you find that you think that'll happen this time with gold and silver?
I don't think that we will run into supply problems that will be long-lasting. Remember that most of the gold that's ever been mined still constitutes supply. The question is, who owns it? I am not unsympathetic to the point of view that a lot of gold that we believe constitutes supply. That is, I'm not unsympathetic to the point of view that much of the gold that central banks are purported to hold, they might not hold. They may have leased out. They may have delivery receipts rather than gold. but the gold didn't go anywhere. So I don't suspect that we'll have supply problems per se with regards to gold. Where we may have supply problems are in the futures markets, particularly with regards to silver. The idea that the silver futures market could trade 100 million ounces a day when there's 1 billion ounces of supply available on an annual basis, and where the amount of silver available for good delivery in the futures markets is 50 million ounces. Now that is problematic to me. The silver futures traders trade all of the silver that's available for good delivery on some days at lunch, and then they do it again after lunch. So it actually could only take a mistake to take the futures markets onto a cash basis, and that would be very, very interesting.
Well, while we're talking about silver, reports out this past week about Sprott selling silver. There's some reports on Zero Head and others. Would you please explain why you guys were selling silver?
Well, first of all, it was not us guys. I am Sprott Inc. I work for Sprott Inc., a company founded by our largest shareholder, Eric Sprott. The selling entity in silver was a charitable foundation associated with the Sprott family. So in the first instance, it was not Sprott Inc., our organization, that sold silver. And as to the reasons why the charitable foundation sold the silver, I will leave it to them to make a response. It was their silver. I would suspect, and I underline the word suspect, that two things are operative. One, they are a charity. They need to raise money occasionally to honor obligations that they have made with regards to their philanthropic activities. That's why they exist. I would also suspect, but I am not saying this is true. I want them to say whether or not this is true. I know from personal conversations with Eric that while Eric believes that silver is selling at a steep discount to what it will sell for, he believes that the silver equities are even cheaper. So I would not be surprised, but I will not warrant, that one of the things that Eric is doing is raising cash by selling silver so that he can buy the even more leveraged silver equities. If I were a betting man, and I am, I would suspect that when the information comes public that there will be some semblance of that in it.
Okay, fair enough. Next up, let's talk about the Cypriot gold. I mean, the whole Eurozone. Christine Lagarde, the director of the IMF, said last week that the whole world has gotten a lot better in the last 6 months. It's not quite as dangerous, her words. I'm paraphrasing, but the world is not as dangerous as it was 6 months ago. I don't understand that. The Japanese are printing $1.4 trillion. The Cyprus situation is a giant mess. There are reports out of the UK Telegraph that they just seized the Cypriot gold, that there was a dispute, and now it's been seized. That there are problems in Portugal, problems all over the Eurozone. So let's talk about the Cypriot gold. Apparently, they took 3/4 of the country's gold. One report says the Monetary Union has put them in a straitjacket. I mean, they're going to take the last remaining good asset they have. They're just going to take their gold. What do you think about that? 3/4 of their gold, anyway. Seized.
Well, Cyprus is a fascinating subject. It's interesting that if they did seize some assets that Cyprus had, they didn't seize Eurozone-denominated treasuries, and they didn't seize euros. They seized gold. That says something in and of itself, if that's in fact what happened. And were I personally a creditor to Cyprus, and if I personally had observed the response of the Cypriot electorate to honoring their obligations to me as creditor, I would seize anything I could possibly get my hands on. The idea that I, as a German taxpayer, have some biological responsibility to sustain the lifestyle of debtors who have lived for 2 decades beyond their ability, I'm not surprised that they seized something. I think the other thing that needs to be discussed in the context of Cyprus, and in the context of the discussion that we're having with regards to gold, is if you were a Cypriot citizen, and if you had stored your purchasing power in gold and silver, as opposed to having your money on deposit in a Cypriot bank, the Cypriot banking crisis for you would be interesting but not relevant. If you had experienced a $70 decline per $1,550 ounce, as opposed to a 40% loss from confiscation, you probably wouldn't regard a $70 decline as being particularly germane relative to what happened to your neighbors. And this whole set of circumstances where the events in Cyprus are being used in the near term to cast dispersion on gold's performance in a portfolio seem very silly to me. From my personal point of view, what happened in Cyprus is an argument in favor of holding gold and silver. Think about the difference that a person had, the experience of that person who was holding physical gold or physical silver or physical platinum or palladium rather than having euros in a Cypriot bank account. And think about what that says for the relative advantage of each asset class. To me, it's very, very clear.
Two questions to close out. I hate to try to get a prediction out of it, but I'm going to. Target for gold and silver while we're looking at sub 1,500 gold. And do you think we're headed for flat out? Are we headed for a collapse? Are we headed for a financial calamity? Is it baked into the cake?
I'm going to duck in some fashion both questions. I don't do market forecasts other than to say higher. Warren Buffett famously said that markets are such enormous topics that there are more variables than the human mind can comprehend. So time spent trying to do exact market forecasting is time wasted, and I try not to be a time waster. With regards to a collapse, my suspicion is that the current calm is a function of confidence. Ambrose Bierce reminds us that the root word of confidence is con. And from my set of circumstances, I am nervous enough about black swan style events that could shake confidence, and nervous about the proposition that central bank liquidity is a sufficient offset to the insolvency of whole societies like the United States, Western Europe, and Japan, that I have an extreme nervousness with regards to a collapse. But if you assume that we didn't have a collapse, it would seem to me that the only way that we can avoid a collapse is if we inflate away the net present value of our social obligations. In both sets of circumstances, I personally am more comfortable owning precious metals than not.
If there's a nuke set off on the Korean Peninsula or attack on Japan, is it over? Is it calamity city?
You're a perpetually cheerful guy, aren't you?
That's what's going on right now.
Yeah.
You have to be looking at these scenarios as, you guys billions of dollars under management. You have to be looking at these scenarios. What happens if a nuke goes off in the Korean Peninsula or just war? What happens?
I suspect if a nuke went off on the Korean Peninsula, that the first thing that would happen would be that all asset classes that had bids would sell off as people went for liquidity. And my suspicion is that if a nuke went off on the Korean Peninsula, that the first move in precious metals would be down. The reason that I believe that is because I believe that many financial holders of gold, like many financial holders of other assets, are leveraged. And the sell decision would be made by a margin clerk, not by an investor. So I suspect that like the 1987 precipitous decline in equities, like other liquidity-constrained markets, that the first move would be down in gold and silver. I also believe that precious metals would hold their value over time, unlike most other asset classes.
And the second move?
Oh, the second move I think would be higher. At least I think that gold and silver would maintain their purchasing power, while other assets, as an example, U.S. 30-year treasuries, would begin to approach their intrinsic value, which might 30 years from now be zero.
Rick Rule. He is the chairman and founder of Sprott USA. Thank you very much for joining us today on USAWatchdog.com.
Thank you for the opportunity in times like these to be heard. I appreciate it.